The market just have basically three ways which it moves. We have impulse, correction, we have impulse, and we have impulse and crawl, you know. So sometimes impulse means the market goes up and drops back down immediately. When you see this in the market, stay out of it. When you see a move fast, just goes up and the next move just come back down fast without might be slow, you know, you have to know that the market is confused. Buyers and sellers, nobody is in charge. Buyers take it up, sellers take it down. So basically at that point, nobody is in charge. So you cannot really determine if buyers are going to continue or sellers are going to continue. So trading at that time is kind of a little bit of gambling, you know. So because, like as I said, you have to be able to predict who is in charge. Is it buyers or sellers? And you position yourself with who is in charge of the market. If you are positioning yourself against who is in charge of the market, then majority of the times you see yourself in profit. At the end of the day, or in losses. You know, if only you succeed to see yourself in a little bit of profit. So trading against the trend is not really that good. So if you see impulse, you stay out. And then the next move we have is impulse correction. Impulse correction, that is impulse and a little bit of correction. So now that is the most common move for trending markets, impulse correction. In short, these moves are just based off trending markets. We have ranging markets, we have choppy markets. But then trending markets, we have just three ways which the market can move. We have impulse, and we have impulse and correction. Now, impulse and correction is the best, and that's what we are really going to be looking for. Once you copy a chart, you look for a market that is trending, impulse corrections. You focus on that market, you know. So you don't just open charts and just pick charts randomly, you know, because some people just open and they just decide just picking it there and they're just trading randomly. So you have to open your market and you scroll one after the other. You look for a chart that gives you impulse corrections, clear. Now, the next thing you have to do is just to wait for an impulse move to develop, or if the impulse move has not developed, you wait for it to develop, and now you wait for it to correct, and now you use your Fibonacci tool. Just determine where the correction is going to end, and you wait at that point. If price gets there, you wait for your confirmations, and you buy. So that's what it is. And then the next move after impulse correction is impulse crawl. Impulse and crawl. So we have impulse and we have crawl. That is, the market was trending, it was moving up,